what I want to first understand is what was this bank regulation that led to people starting their own private credit funds?
So in the West, at least, so Basel one, Basel two,
Mm.
and then Basel three, even basically what
Yeah.
happened that the government, the federal government, didn't no longer wanted to give banks entrenched in all type of financing, which
Okay.
meant that if a bank is to go down, all parts of the economy goes down. So they
Okay.
thought, no, some things you cannot do, and if you do it, you're going to take a penalty on your capital reserve requirements.
Okay.
So if you're giving that many loans, you're going to need to have that much cash in reserve.
Yes.
So in case things go south, you have the cash to offset that losses. So because of that, a lot of the lending to mid-market corporates, SME lending, shifted to
Yeah.
private credit managers. So that was partly the main reason the growth of in the US, which led the market, it's the biggest, deepest market for private credit. For our region, it was slightly different.
Yeah.
For our region, is because entrepreneurs or small family groups that have been running for 5 years, 10 years of business, they really had two options. Either they have their own family and friends' money to give them to
Yeah.
grow, or they sell equity, which was very expensive,
Yeah.
right? If you're selling equity, it means the person who's buying is looking to make 25% plus. When you're doing with getting financed from private credit, you're getting 15 to 18%. It's a lot more digestible than 25 plus. But it took a long time for people to understand the non-dilutive aspect of private credit versus private equity as the only option for people.
Can you explain the
Sure.
difference between?
So private equity, let's think of you as you're a company. You're a company in UAE, you're a company in Saudi, and you've had 5 years of audited financials, you're growing pretty well, $50 million top line. It could be in any sector. So we're sector agnostic. We don't,
Okay.
as long as it's cash flow generative, we don't care.
Okay.
One sector we don't really do is construction, just because the natural life cycle of a construction business is very lumpy.
Yeah.
So the cash flow is not predictable. We need predictability, because we know how much is the maximum we can make as private credit investors. So our number one goal is never to lose money.
Yeah.
That's the number one thing, because if we're not a VC, we're not private equity, where sometimes you can have one unicorn that can lift the whole fund, right? If you had a couple of zeros. So our goal is never to lose money. So you as a company, as an owner of a business, you come to a stage where now you need to grow further.
Yeah.
You have a private equity manager come to you, say, I'll buy 30%, 20%, 50% of your business for this much. It will allow you to grow further. That's one opportunity set. The other opportunity set is a private credit manager comes, says, for that same 50, 40 million, whatever it is that you need, we'll provide it for you for 4 to 5 years. We're not going to own any part of your business.
Okay.
So if you think your business is going to be grow even further, then the challenge we were trying to explain to people in 2009 was, let's do the math. If you were to sell 30% of your business versus if you were to take a loan for that amount, in 5 years' time, what is your business going to worth if you think that yours is going to continue growing? And if the math shows that it's a lot cheaper for you to get loan rather than dilute your equity, then do with us. If the math says otherwise, then go with private equity. That's the beauty about it. They don't necessarily compete with each other, because the math is quite clear. It's either this non-dilutive solution is better for you, that's flexible, plus ownership and dynamics of business decisions. When we as private credit owners, investors, we typically get board seat, but as observers. So just to keep a close eye on the business, but we can't vote. But if you sell to private equity,
they are the ones who vote.
They're gonna have decisions. They're gonna be interjecting into your business.
Yeah.
And most people don't want that, right? And maybe not at a certain stage. Maybe when they get to a certain stage before they really want to exit their whole business, they would. But most business owners don't want to have others coming into their. Look, entrepreneurs in general, right? Right or wrong, they have their own views, and what got them to be successful is that combination of intellect and their gut feeling. And if somebody starts coming and interjecting and putting doubt or sometimes it's the right thing to do, but a lot of business owners don't want that.
They don't.
So the difference between private equity and private credit is, one is you're selling equity of your business. So there's ownership decisions, there's upside participation and all that. On the private credit side, we're effectively financing you where banks are not even going to give you finance. Or you're not big enough to create your own, issue your own bonds. If you're a big firm like a ADNOC or whatnot, you can just issue a bonds, right?
Exactly.
And it'll be cost effective. Or you can even get financing from some of the big private credit firms that want to give you $500 million, $1 billion for an oil pipeline or whatnot. So those are what the two main distinctions. And from an investor point of view, the two distinctions is private equity, you have a lot more potential to make a lot more than 25% IRR.
Yeah.
For our region, however, the big challenge has been realizations have been as prevalent as in the West. So people can come into a private equity fund. On paper, it looks great, but historically, at least, there hasn't been that many exits. So on
Yes.
paper, you may have reached 25, 28% IRR, but you need to actually
Yeah.
sell that company for you to
I
get the money.
completely agree with you. This is also something that I've noted. There are businesses coming up, but you don't know who to sell to.
Correct.
You don't know where to go beyond this, right?
Correct.
Yeah.
Correct. And so you either end up having to wait for maybe an international firm of
Yes.
similar sector to come and uplift
Buy
you,
you,
like
yeah.
in the case of, one of the region, you unicorn Kareem.
Yeah.
Uber took it,
Yes.
right? If it wasn't Uber, it would have to. Who else would have?
Yeah.
Maybe it could have IPO'd, but it's the real natural transition was when Uber came and said, okay, they've built a great platform. Let's just
Yeah.
take them. On the private credit side, because our upside is limited, meaning it'll be surprised if we make more than 18, 19%. Sometimes we structure warrants,
Yeah.
so it may give us an upside participation, but typically we have a very clear set. For us is downside protection and steady income stream, meaning
Yeah.
quarterly distributions. Our investors invest with us because not only for the 17% return, but 10 to 11% of that
Yeah.
comes in a cash coupon that comes every quarter.
Yeah.
So for a proper asset allocation model, you should have a bit of public equities, public fixed income, alternatives, private equity, private credit.
Yeah.
It's getting things some that pay you regular income and some things that give you more growth
Yeah.
to your portfolio.